there are people who feel like money is so important to the point that if they see their bank account balance drop a little bit, they feel like they don't have security in their life. People tend to overreact to news. The Singapore Exchange is well known for certain kind of companies. Banks, for example. You look at property also as another playbook. Let's say you make a trade and the trade moves against you. I actually think that's a good thing. That stops you from having the presumption that you are so smart and that you can out-trade the market. Nobody who's new to swimming is going to jump into the deep end of the pool. And it's the same thing with investing. If you're not confident, you shouldn't be jumping into the deep end of the pool.
If you've ever felt like you should know more about money by now, you're not alone. Many Singaporeans feel the same way, which is why today's guest is perfect for this conversation. I'm Sabrina, and I'm here with Timothy Ho, co-founder of Dollars and Cents. And today we'll be talking about Tim's very own personal finance journey, whether we're overlooking the local stock market in favor of global hype, and what young Singaporeans are getting right or wrong about their money. Tim, it's great to have you here.
Thanks, Sabrina. Nice to be here. Thanks for inviting me.
Let's start with your story. Tell us, what is Dollars and Cents?
So Dollars and Cents was an idea that me and my co-founder Dinesh had back when we were in university. So I think that was between 2010 to 2012. And I think when we first started Dollars and Cents, we didn't even think of it as a website, right? So we didn't even think of starting a website. It was more like an idea of how can we make finance, which was a topic that both of us were pretty passionate about, more relatable to other people, right? And back then, I think for those of you who are old enough to remember, finance content was very much not like what it is today, in a sense that most publishers back then, or your traditional media, they cover finance from the perspective of, okay, how would this make sense for someone who's already in the finance industry or someone who studied finance in school, right? So in other words, it was targeted towards people in the industry or business leaders. So that's why you have like your Wall Street journals and your New York Times or even Business Times, right? And we felt like finance was a topic that is actually very relatable, very important to everyone. But then we didn't see any publisher back then writing it from the perspective of what the layperson needs to know. So that's how we started Dollars and Cents.
You mentioned that you were very passionate about finance, right? What was your own relationship with money like? Did you always have it figured out already, or did you learn the hard way like the rest of us?
Okay, I would say that obviously when I was young, I haven't figured it out, right? So my parents were both I would say, middle income, lower middle income people who work for other people, right? And money was just a topic which, it's all about budgeting. It's about making sure that, how much we spend as a family each month is lower than what my parents brought in, so that we have enough to save for a rainy day. So growing up, my idea about money was simply, when I am older, I need to find a good, stable job that hopefully pays me enough so that I can take care of my family. It's only when I was in somewhere, I think between the time when I was in army all the way till uni, when I started realizing that it's not just about saving and spending. It's also about investing our money, growing it, and taking charge of our finances so that we're not beholden to just making sure we spend less than we earn. And that's where I started really exploring investing, started with a bit of trading as well, just because, every young person in uni wants to trade because they think they can beat the market, right? So that's how I got really interested in finance. And then when we started Dollars and Cents, I started realizing it's not just about investing or trading, it's also about property decision, credit cards, buying the right insurance coverage, and obviously planning for your retirement.
So would you say that this started out as like a hobby project? Or did you see it as okay, this is my career moving forward?
I think it started as definitely a hobby, interest project, right? So when we started Dollars and Cents, I think I would say, on behalf of both Dinesh and myself, we had no idea that it would be a business. No idea that it would even be a job, let alone a business that we run. So when we started the website, I remember we live it in 2012. So for the first 3 years from 2012 to 2015, we look at it purely as a passion project, right? So we're just writing articles on weekends. We both had a day job. So we're just writing articles on weekends. And I think it got traction. Thankfully, sometime in 2014, 2015, we started getting people inquiring regularly about advertising collaborations or just partnerships in general. So then we started meeting them because they asked us out. And then we started getting a bit more interested in how we can take dollars and cents to the next step. So I think it was only in 2015 that I left my job to do this full time.
Was your day job also related to finance or completely different?
It was related to investor relations. So it's not finance in a sense that the company I worked for wasn't in the finance industry, but they were a listed companies. So I had a lot of investor relations related things to think about as well.
Okay. And you're juggling something that many Singaporeans talk about, but not many feel very ready for, like building a career, growing a successful platform, and raising kids in a world where everything feels more expensive. Has becoming a parent changed the way you view financial planning?
I think most definitely it has. I think the biggest change for me personally is that when we started Dollars and Cents, I always thought of finance as we use the term personal finance, right? Because we think it's every individual thinking about finance on a personal level. But when we had kids and even when we got married, but more specifically when we had kids, I realized it wasn't like personal finance, right? It's more like family finance or couple finance if you think about it. Because a lot of the personal finance decisions that you will want to make for yourself may not necessarily be the same decisions you want to make once you have kids, right? So you start to think about, I give you a simple example, right? Like, I think when my daughter fell sick the first time, I think she was about 4 months old or something, and we went to the pediatrician because, we as kiasi parents, you're like, oh no, what's wrong? I better do something about it. And I was just shocked at how expensive it was, right? Like a few $100s for a PD visit, right? Because we're used to GP visits, which are like $100 or less. So when we went to the PD, I realized just how expensive it was. But you see, finance wasn't the first thing I thought of. Money wasn't the first thing I thought of when I went to the PD, right? To me, it was like, as long as we know what's going on and she feels better, money doesn't matter, right?
Correct.
And I started realizing that when you become a parent, you start thinking a lot about your money decision, less in terms of the dollars and cents, pun intended, but more about how, spending or allocating money feels to you, right? You start to realize that it's not just about accumulating as much as I can so that I can retire early from my job, but also about spending it wisely as well, so that whatever you spend your money on are on things that truly matters to you.
Would you say that this has shaped how you also inculcate these kinds of values in your kids? Like, would you also tell them like, oh, you need to hustle early, like you need to hustle and like get a part-time job, for example, when you're a teenager? Or is it more about investing early?
All right, great question. So I think for me, right, it's like, okay, I feel personally that saving is the bedrock of every other financial habits, if it makes sense, right? So if you're not able to be a good saver, it is very difficult to, become a good investor, because a lot of young people would have this feedback, which is that, hey, I barely earn any money, from my allowance or from my NSF allowance, right? So how can I possibly have enough to invest? Which is kind of true, because when you're young, you don't earn a lot, and you might think that because I don't earn a lot anyway, why should I bother to save? Because it's not going to be meaningful. But I think at the base of it is developing the saving habit, right? So even if you earn, let's say, $600 a month, and you think saving $200 wouldn't be meaningful, it is okay, because what's more important is that you're developing the habit of saving. So I think for my kids, that's where I try to teach them at the start, which is also a lesson that my parents taught me, growing up, which is that just because I give you like $2 allowance each day doesn't mean that you spend $2, right? Correct. Even if you save 20 cents, it's still something, right? Because you're inculcating in your kids the habit of saving. After that, or rather alongside saving, I also realized one thing, which is also about learning how to spend wisely. I think that's something that not all of us may always think about, because we might think of spending as just equal, right? If you spend $10 and I spend $10, that's the same. But I think you can also explain to your kids sometimes that there is a way to spend $10 wisely, and there's a way to spend $10, in a less than ideal way, right? So spending $10 wisely in the most ideal case will be like buying a textbook that they need, right? Or buying a book that they need for school, right? Or buying a present for a friend for a birthday party that, they're going to. That's kind of like spending wisely. Spending less wisely could be like, let me think of a less than wise way that my kids will spend money. Walking through a toy shop and then buying the first thing they see that catch their attention for $4.90. That's a less than ideal way, right? So I think spending wisely is the next thing. And then I think when they grow a bit older, my kids are not yet in their teens, but when they are in their teens, I think it would be good for them to learn a bit about how money can grow also. So I think that's an important lesson. So I always tell them that money is like a plant. If you water it, it can grow as well. And over time, it can bear fruits for you. So I think that's the investing part, which maybe will come in a bit later on.
Okay, you mentioned about spending wisely, right? Some would argue that, but I spend for the experience, and that it's all about perceived value. If I feel that the experience is good enough for me, then that would be counted as spending wisely. Would you agree?
Yeah, I agree. So one classic example I would share is that coming out of COVID. So I have 3 girls now, right? So we never took a family vacation before COVID because our youngest wasn't even out before COVID, right? Okay. So coming out of COVID, I think it was 2023, my wife really wanted to go to Japan and we decided to go as a family, right? And so obviously it's not so cheap, right? When you're going as a family, but it's still one of the best trips I've ever taken. And I think spending on experiences is certainly a great way to spend money, as long as it's on the right experiences with the right people.
All right. Thank you for sharing. You've spoken to so many Singaporeans over the years, and everyone's money story is definitely going to be a bit different, right? So when you look at the conversations you've had, is there anything that stands out to you in how people tend to save or invest today compared to years ago?
I think the biggest thing that I always like to encourage people not to think too much about is to take either extreme view of your money decisions, right? So I know that there are people who feel like money is so important to the point that if they see their bank account balance drop a little bit, they feel like they don't have security in their life, right? And because they're so concerned about financial security that, every dollar that can be saved has to be saved. And I think that's a very unhealthy way to think about money. On the other extreme, obviously, it's also very unhealthy to think about money as something that you just need to spend to experience life. Because it's like my analogy here will be like, you think about farming, right? I'm not a farmer, but this is just something all of us would know, right? So when a farmer harvests their crop, they always leave a little bit aside so that they can grow the next batch of crops, right? Because if you eat everything today, then you have nothing to grow for next year's batch. At the same time, they also keep some to consume in the future when it's winter or something where the crops don't grow. So there's a bit of that logic here, right? Which is when we harvest our crops or slash our salary each month, we set aside some money to spend and to enjoy, obviously, within our budget. Secondly, we save a little bit as well so that in case, we need to spend the money 6 months from now, we can afford it. And then lastly, we save some to invest as well. So I think that's the mindset we need to think about money. And not to take extreme views about money when it comes to saving. The same thing goes for investing as well, actually. I think a lot of us, when we start to learn about investing, we tend to make decisions about what's the best way to invest or what's the best stock to buy, for example. And because we think this is the best way or the most ideal way, we put all our eggs into that one basket. And I think that's a very poor long-term strategy because it is true that you might be attracted to the markets for a certain 1 or 2 stocks or sectors that you're looking into, and you will probably put a bit of money to invest or trade it at it. But over time, as we grow older and as our knowledge expands, we should also find other ways to grow our money, right? So that we so-called diversify our eggs into multiple baskets rather than to, take a position of, okay, this is the best way to grow our money.
So as someone who saved since young, what would you say to someone who maybe hasn't developed that habit and is maybe they feel like, oh no, it's too late for me? What would you say?
Well, if you're a working adult and you haven't really developed the saving habit, you save towards your first 10,000, but you invest towards your first 100,000. And I think that quote kind of makes sense to a lot of people, including myself, right? Which is that your first 10,000, don't worry about investing. Just develop the saving habit, set aside a portion of your salary each month and save towards $10,000. But once you have built that saving habit, you can't just save forever towards your retirement. You need to let your saving grow as well, which is why you should invest after that, right? So I think that makes a lot of sense. And for anyone who hasn't saved yet, I think, just think about that quote, right? Save towards your first 10,000, but invest towards your first 100K.
It's never too late to
It's
start,
never
right?
too late. Yeah.
Okay. It's interesting hearing how our relationship with money has changed. And part of that is shaped by the information we pay attention to. When big global headlines come in, like US inflation numbers, tech earnings, Fed decisions, they tend to drown everything else out. But day to day, the decisions we actually make come down to the local things that matter, right? Like CPF, housing, taxes, our jobs. So there's always this push and pull between global noise and local reality. So how do you approach that balance when you're creating content, helping people understand global news without losing sight of what actually affects them locally?
Great. Yeah. So I think one of the things that goes without saying is that there's always going to be noise and interesting things that people are fascinated about in the markets, right? So when Donald Trump got elected the first time, I think we wrote an article. I think that was surprising to a lot of people that he won the election. And I think we wrote an article about, Donald Trump has won the US election. How will this affect Singapore investors? And it went like crazy viral, like within like 12 hours. Like it was a crazy amount of numbers. So I think the take home here is that definitely there are things that are always going to happen on a global scale. And it goes without saying that these things do impact the markets, at least in the short term. And there will be a lot of Singaporeans who are also going to be concerned or thinking about, okay, how does this, changes what I do for my investment portfolio or my strategies going forward. I think as a publisher, what we try to do is that we do cover some of this, big news that surprises the market or things that can move the market. But we always try to take it from a Singapore perspective on which, okay, what does that potentially mean to you, right? And I think quite often people tend to, in my opinion, overreact to news. Right. And maybe that's also because of websites like us that covers it as well. Right. So the media always wants to, sensationalize headlines, right? They want to make you think that there's something in there that you better read the article, right? And I'm not saying that as a publisher, we are absolutely, absolved of this responsibility. We also know what people want to read about, but sometimes we tend to overreact because of, the news outlets. And I think as a person in Singapore, if you're a Singapore-based investor, it is important to recognize that your plans are for the long term and that a lot of things that happen in the short term will not really affect you as much as you think it will, because you're not a short-term fund manager that has to make constant decision every day about money matters, right? So I think that is one thing that we should remember.
And, building on that, do you feel that because it's so loud, Singaporeans tend to get pulled very strongly towards the overseas markets rather than what's going on in the local scene?
I think so. I think media definitely play a part in terms of our biasness towards markets, right, in general. So, the US dominate not just the financial market, but the media news outlets as well, right? All the big major news agencies that we consume from outside of Singapore are likely to be US websites, right? So besides the US websites, it's just your local publishers. So I think the US definitely have a major influence in the way we think about our finance. But I think it goes without saying that, as Singaporeans or people living in Singapore, we need to care more as well, care about things that are happening in Singapore, right? So quite often you see people come to a website like Dollars and Cents, not necessarily also for the major news that they can already consume by going onto Wall Street Journal or Bloomberg, but they're coming to a publisher like Dollars and Cents because they want to know the local stuff that matters to them, right? So let's talk about year end, right? If we're talking about year end, we're talking about traveling, we're thinking about multi-currency cards that you can get in Singapore, right? You're not thinking about a multi-currency card that's not available in Singapore. If you're thinking about buying a house, you think about your HDB flats and all the regulations that comes with it. That's the logical thing. And if you're thinking about retirement planning, CPF is surely going to be one of the main topics you think about because that's what matters to you most if you're thinking about retiring in Singapore.
That's right. And, because people get information from so many places now, right? I'm sure you're familiar with it, like global news, influencers, TikTok, YouTube, Telegram group chats. How do you think someone can tell what's actually reliable and what signals would tell them that, okay, this is something that they can sort of trust?
I think the biggest challenge, especially in the social media world that we live in today, is that you're constantly going to be fed content that, the platform thinks you want to consume. Someone who is super into, stocks in the US will get that kind of content being served to them. So there's a affirmation biasness that is quite dangerous if you ask me, right? It's a little bit different in my opinion compared to, let's say, I'm going to Japan at the end of the year, right? And I'm being fed content that what I can do in Tokyo. I think that's kind of okay because I'm going to travel there. I'm going to eat a certain kind of ramen or sushi. And, if my social media feed is giving me, where are the best sushi places to go to in Tokyo, I think that's kind of, the kind of content I might want to consume, right? At least at this point in time. But I think with finance, sometimes it doesn't really work that way. So the confirmation biasness doesn't really help us so much. So I think sometimes as a investor, you need to force yourself to take a step back and really think of the big picture that you're thinking about and not be drawn towards any kind of biasness that might affect your investment decisions.
It's very similar to like an echo chamber for like political news, right? So I guess the tip here is to make sure that you do your due diligence always. You always have to research both sides of the story.
Yeah, I think echo chamber for like politics is a good example that you shared, right? So I think with politics, the thing is that people do take sides whether you like it or not, right? So if you are on one side of the political spectrum, then you kind of really want to take that side and you naturally get served content that affirms your views, right? I think for finance, I'm not sure if taking sides would really help us in the long run. Sometimes it might be better for us to have a more objective view on our finances and the way we want to plan towards it rather than having a biased view, right? So a lot of people say if you are too emotional about your investment decision, then you might tend to make poorer investment decision, right? So that's kind of different compared to other topics like traveling, food, or even politics where, being emotional is totally fine.
That's very true. Since we're already talking about what Singaporeans pay attention to, I want to zoom in on something that often gets less airtime, which you also mentioned about, which is our own stock market. So not because it's unimportant, but because the conversations around it tend to be a bit more mixed or less clear-cut. So I'd love to hear your thoughts after years of speaking with investors and readers, right? How would you describe the general sentiment towards Singapore's stock market?
I think the big challenge nowadays for all markets in general, not just the Singapore Exchange, is that with the proliferation of globalization and the internet, markets are increasingly more and more interconnected. So what I mean by that is that gone are the days that a Singapore investor can only gain easy access to the Singapore Exchange, right? Nowadays, even if I'm based in Singapore and I'm a Singapore-based investor, I can get easy access to markets all around the world through brokerage firms, including IG as well, right? So I'm not limited to just the Singapore Exchange anymore, right? So that comes because of technology, that comes because of globalization. So I think one challenge for markets in general is that you will see consolidation, where it might be a situation where everyone gravitates to just a few major markets. And then what happens after that is that companies that want to list might also gravitate towards those markets as well. So I think that's definitely a challenge. I think what we have in Singapore is that we definitely the Singapore Exchange is well known for certain kind of companies. So if you look at banks, for example, the STI is comprised 50% of the market cap. I think roughly 50% comes from just 3 local banks. And these are 3 strong local banks, which are also the strongest banks in Southeast Asia. So I think that's a great place to start from. And then you look at property also as another playbook, right? So we have a very big REITs market in Singapore, one of the biggest in Asia. And I think those are some of like so-called our specialty, also helped largely by the fact that, we are a, dividend exempted country. So you don't pay tax on your dividend earnings, which makes a lot of sense if you're going to get dividend incomes from these companies, right? So Singapore do have some advantages for a local-based investor. And I think for someone who is based in Singapore, especially from an income-focused point of view, the Singapore Exchange do make sense. Obviously, you have to do your own due diligence. In the long run, I do feel that, both investors as well as the market makers also have to consider the fact that, we are living in an increasingly global world. So, we no longer can just rely on local-based investors to invest in local stocks, right? even local stocks would need to attract foreign dollars, if that makes sense, right? Because it's a very global market. And I think that's also the direction that we need to take as well.
And what do you think would help make these kinds of Singapore companies more visible or relatable to the everyday investor?
I feel personally that the US have an advantage when it comes to like just awareness because they have the biggest media companies in the world, right? So because they have the biggest media companies in the world and people around the world, not just in the US, consume the US media, right? And that gives them an advantage because when you kind of like own the media channels, it is easier for you to then have your companies being represented in these media channels, right? So I think that's one of the advantages that the US have, which, if I were to be honest, in Singapore, our local media tend to serve just the people in Singapore, right? So that is a challenge for us as well, because if we are trying to reach out to overseas-based investors, we also need media companies or the media that we have to kind of be able to touch people overseas as well, right? So I think that could be one area that we can work on.
For someone who's open to exploring Singapore stocks but doesn't know quite where to start, what's a simple way to approach the market here?
I think there's, like for me personally, I think about it in two ways, right? The first is really on a broad level. We just look at the Straits Times Index, right? The Straits Times Index, STI for short, comprises of 30 of the biggest and most liquid companies across different sectors, right? So these are the companies that so-called the market has determined matter the most in the exchange. So it makes sense to get exposure to these companies and to invest in it maybe through an ETF to begin with. Over time, as your knowledge builds, you might have certain preferences or certain companies that you want to put in more money into. So that's fine, right? I like to describe it like you go to a restaurant for the first time. You know it's a decent restaurant, but you're not sure what to order. So you just order like the chef special or the omakase meal first, right? And then you just try a little bit of everything. And then after you go to the restaurant a few times, you might have your personal preference. That's where you do a la carte ordering of some of the dishes that you want to have more of, right? So it's the same way with investing. I think that's how we can start. I think the other way we can think about is, since we're in Singapore, some of the companies that we interact with might be listed on the exchange, right? So if you go to Suntec every week for shopping or to attend an event, then you already kind of know what Suntec is looking to do, right? So then you can invest in the Suntec REITs, for example, right? Or the shopping malls that you go into, right? So I think that's another way of thinking about investing in stocks. Just look at the companies that you are interacting with, right? So, in Singapore, we can see how they're performing.
Okay, you've shared a lot about how Singaporeans approach investing, both here and overseas. And after hearing all that, I think the bigger picture is very clear, right? That at the end of the day, making good decisions still comes down to financial literacy. So I want to shift the conversation towards what that looks like for the younger generation today. Do you think that schools are doing enough to prepare the younger generation for real-life financial decisions?
I have a very controversial answer to this, right? I'm just going to say it and hopefully, doesn't get me flagged too much. But I think school prepare us for the workforce, right? So we spend compulsory education in Singapore. So primary 1 to primary 6, secondary school, and then most of us we'll go to IT, JC, poly, and then we might even go to uni, right? So that's like, 15, 16 years of education. And I think that is to prepare us for the workforce. Right, so we find a job and then hopefully a job we like and then we try to do our best there. So I think that's the responsibility of the school to prepare us for the workforce. And in the workforce, what you do is you make a salary and you continue to be employed so that you can be productive for your company and for the country as well, right? So in a way, school wouldn't really prepare us to be an investor, right? And I think that's something that on a personal level, we have to take ownership of that learning, right? Which is that, how can we learn not just to be a good worker in the economy, but to be a good investor as well, so that we're not always going to be exchanging our time and skill for money, but also exchanging our money to make more money, right? And I think that's something we will have to learn on our own. I do think that the school should and is probably trying to educate kids about the importance of other money-related topics. Like, I think schools these days are super into like scams, right? They're trying to educate kids not to fall into scams, whether it's a financial scam or some other e-commerce scam. And I think to me, that's kind of like financial literacy in a way, right? To make sure that whatever you're buying is legit in the first place, right? I think they also try to make it an effort to also educate people about money in the sense that, cashless transactions are also money at the end of the day. So I think that's also a topic that I'm also quite passionate about because I have kids and I realize that kids these days don't grow up in the cash world that we used to live in, right? Where we can see our parents take out money from their wallet to pay the taxi driver for the taxi ride, right? I used to look at a taxi meter and think, oh my gosh, like every 30 seconds when he drives, it goes up and it gets more and more expensive. Today, like when we take a Grab ride, our kids don't even see the bill, right? You don't even see the bill, you don't see the payment as well. So to me, I think that's one thing that I'm a bit concerned about, that I think we should teach our kids, which is how to appreciate the value of money and to recognize that money that you don't see being used is also money, right? So if I tap my credit card, I'm actually paying.
Do you think that it's detrimental to them that we are moving into a very cashless society, but is that not very good in schools right now?
I think it's detrimental if we don't have different ways of teaching them the value of money. So like it certainly is detrimental if, the kids are not even recognizing that taking a taxi or Grab ride, you have to pay for it just because they don't see it, right? I think I still remember my kid. This is a crazy funny story, right? So she was primary one. When she was in primary one, she brought her wallet to school, right? And then I was supposed to give her money like every few days, right? And then I think I forgot to give her for a few days. So I asked her, hey, have I given you your allowance? And then she said that, she lost her wallet. Okay, she didn't lose it. She left it somewhere in school, but she found it the next day. But she said that she lost her wallet and then, but it's okay because she can pay using her EasyLink, so she don't need money. Then I had to tell her that, oh no, your EasyLink is also money. So nowadays, whenever she has to top up her EasyLink, I make it a point to bring her to, the EasyLink counter, which I don't even know where it was. Actually, only until recently, right? Because I barely top up my EasyLink, right? So I have to bring her to the EasyLink counter and then I have to show her that, okay, we're going to top up $20 so that she knows that I'm putting in $20 into her EasyLink card so that she recognizes that it's money. So I think we have to find all ways to teach them about money, even when we go to a coffee shop sometimes or a restaurant, right? Like when we pay using it, we sometimes try to give them cash and make sure that they know to take back the right amount of change as well.
Correct. So would you say that the onus kind of falls on the parent rather than the school?
I think the responsibility of teaching our kids about money matters really is something that parents have to recognize, that it's also our responsibility as parents to teach them about money. And the way we learn about money growing up and the way it is today is quite different as well. So that could be some level of challenges that, even I face that challenge, trying to educate them about money. I try to teach them, sometimes when there's a discount at the supermarket, like, 2 for like $2.90 and 1 for $2.70. I tell them, does it make sense to buy an extra one because it's only 20 cents more, right? So I try to teach them all these kind of concepts.
Okay. So you shared about understanding the value of money from a young age. What about investing? Like, when should they learn about investing?
Oh, for kids, is it? I do think that it's quite scary to, just give your kids the leeway to start investing at age 18 without a gradual, lead up to what they can invest in or them understanding about investing in general. So for me, I feel like, I will always encourage students these days, if you're watching this, just to pick up and read a few investment books that, I think, there's quite a lot that you can get. And I think that's, to me, is a very good and traditional way to learn about investing. The second thing I will always say is that even if you want to start investing or trading, do it with lesser money, right? Because when you are investing a large sum of money, you tend to be more emotional because you have that fear of losing it, for example, right? And that allows you to make suboptimal decisions sometimes. So you must always learn to invest or trade with an amount that you are comfortable with losing, and then use it as, you can call it, textbook payment, right? Or what they call that? Tuition fee. You call it tuition fee, right? Where, you can afford to lose $500 or $1,000 in your first investment or your first few trades. And it's just tuition fee, right? You're paying to be taught by the market that, it can move against you. And I think it's a great lesson. I think it's worth paying $1,000 and to lose it, within a month, if the lesson you learn is that, putting in money in the financial markets can result in significant losses. I think that's a money well spent, actually.
So, like previously, maybe in the older generations, we all had to learn about investing on our own. But as a young parent today, right, would you say that you would have the privilege to start that investing journey for your kids? Like start an investing account, for example?
I think the best thing about technology today is that it has really made investing a lot more accessible, right? So it wasn't too long ago where you could barely invest in an ETF. I'm not sure if you are old enough to remember those days, because I think ETF really got popular in Singapore, I think only in the early 2010 or something. So even when I was in a uni student, back in school back then, right, there were very limited choices for ETF investments, and you could barely invest in bonds because bonds were just so expensive, right? Like 250,000 per bond, and no student would have that kind of amount to invest in any kind of bond. So how do you even get diversification, right? So I think today, the technology has allowed so much more ways for us to not just invest, but invest with a small amount and still get a very diversified portfolio, which I couldn't do 10 years ago, because I couldn't get a diversified portfolio with just $2,000-$3,000. And I think this is an easy way for parents to start investing for their kids. I think over time, what I would love to have would be in a position where I can slowly hand over to my kids some of the portfolios that, me and my wife have been investing for them since young. Obviously, at an age where they are responsible enough so that they don't just liquidate everything and spend it all in one shot, right? So I think that's the gradual way that we will do it. I think I also feel like technology will continue to evolve. Right. So maybe going forward, people will not just be investing in traditional asset classes. They might be more alternatives, not just alternatives, but an easier way to invest in alternatives as well. So I think there are definitely a lot of options, but I think most importantly, the parents themselves must also understand these things before you even try to invest for yourself or for your family.
Of course. How early are people starting these days?
I feel personally like there is two main stage in life where I see a lot of people getting super interested in investing. The first is when they enter tertiary education for some reason. Maybe it's because in uni, people have less time, have more time to do stuff, not just worry about mugging for their exams these days. So they think about investing, and they start to get very excited about trading the markets and making profits or making losses, when they trade, right? So I think that's the first time I see a lot of people getting interested in investing. The second stage is really when they start thinking about their future, right? For some people, it could be when they get their first job. But I think more often than not, it comes, when they're in their 30s, they have a family, and they start to think, hey, I better start to invest for my retirement. Otherwise, it might be too late, right? So that's the second time where they start thinking about investing. I think the problem with investing when you're older is that you might feel like you have less time left. So then, even though you should be taking lesser risks, you end up taking more risks because you want to compensate for the fact that you didn't invest in your earlier years.
Or the lost time.
Lost time, right? Because we all know that money compounds over time. But if you have less time left, you might be, tempted to take more risks in order to compensate for it. But that's actually a very bad strategy because it's precisely because you are older and you have less time left to retirement that you should be taking lesser risks.
Correct.
Instead, what you should be doing is that you either start your investment journey earlier or you set aside more money if you start investing in your later years. That means if someone can invest $500 a month, from young, and you are already in your 40s or 50s, you might want to like double or triple that amount that you invest each month.
Okay, but choose a more conservative portfolio
Yeah.
with that larger sum of money.
Something you understand and something that you are willing to take the risk for, in terms of risk tolerance level.
And young adults today are more exposed to financial topics than ever before, right? But exposure doesn't necessarily equate to readiness. Do you think young people feel confident with their financial choices today?
I think that there is always going to be an element of like just trying it, try and error in some sense. So like the way I think about it is like, learning how to swim versus swimming, right? So you can learn how to swim, or you can try to learn how to swim watching YouTube videos or whatever you want to do, right? But it's only when you step into the swimming pool that you can truly learn what it means to swim, right? The logic here is that, nobody who is new to swimming is going to hopefully, jump into the deep end of the pool and try to learn at the deep end of the pool, because that is incredibly dangerous and you don't want anything bad to happen to you. And it's the same thing with investing, right? If you're not confident, you shouldn't be jumping into the deep end of the pool. You should start at a smaller amount with a product that you are more aware of, or a lower risk product, and gain a bit of like investment confidence, like water confidence first, before you take that step into a deeper end of the pool when you're more confident. So I think when you talk about financial readiness, it's the same thing, right? You're not going to get there overnight, right? You're going to get there, or you're only going to feel comfortable or confident about your investment or financial decisions over time, because you have done it before and you know how this will look like. That you know that when you invest in a product, you go through a recession or a crisis, you come out stronger. That's where your confidence are going to be built. So I think my suggestion is just, start early, start with an amount that you're comfortable with. Be okay with making losses. Anyway, you're young, so you will recover from it. And then as you gain more confidence and more knowledge, then you can make better investment decision over time.
That's a very fair perspective. And on that note, what are some of the most common mistakes you see first-time investors making?
I think the first mistake I would say is, to start. I mean, not a mistake, but the first thing they should do is to start early and to start small, right? So the mistake is to start later and start with a larger amount, and then,
Taking a risk.
and the risk move against you, and then you make losses. In fact, I would even say that if you start early and start small and you make an investment decision, let's say you make a trade and the trade moves against you, I actually think that's a good thing. I think that stops you from having the, that presumption that you are so smart and that you can out-trade the market and make a higher return than other people, right?
Correct.
So I would rather learn that lesson early, that I can make investment mistakes when I'm younger and I'm investing a small amount, than to start at an older age and putting in a large amount only to learn the lesson in a more expensive way. I think that's the first thing. I think the second thing is really, not diversifying your portfolio. I think that's a mistake, because diversification is the only thing, that the market can offer you. So you get similar expected return at a lower risk, right? So I think diversification is one thing we should do. And I think with a lot of new investors, the problem is that usually when they start investing, it's because they saw some headline news, right? So they saw that NVIDIA or Web3 or AI is going to be the next big thing, and then they invest their money into that trend, right? And I think while that is an okay way to get excited about the market, because it's better than not investing, it is not the most ideal way as well, because you're not enjoying diversification. So, once you enter the market, try to diversify as quickly as you can, and as in a cost-effective way also.
All right. Let's wrap it up with one final question. What are some words of wisdom you would give to the younger generation about handling money early on? Like, I know you mentioned a couple of tips already, but what's one very important one in one sentence?
I think for me, it's like just have a healthy habit with money, right? Don't let money control the life decisions you make. Instead, your life decisions that you make should be the life decisions that you want to make, and then let money be the enabler of that, right? So just have that healthy habit with money, and remember to spend wisely, save if you can, and invest when you're confident to do so.
Nice. I think that sums up our podcast episode today very, very nicely. Tim, thanks so much for chatting with me today. I think a lot of people will find that your perspectives are very helpful. I definitely felt that way.
Yeah, hopefully it helps, and I'm glad to share my insights.
You know, you've reminded us that financial literacy isn't just about the numbers, it's about understanding the basic concept of money, you know, starting early and just being confident and taking charge of your future. So if you found this episode helpful, do share it with someone who is looking to get smarter with their money. Don't forget to like, subscribe, and hit that notification bell so you don't miss out. And we'll see you in the next one. Bye-bye.